Hello and welcome back to Stockwisely, the channel where we discuss the latest news and trends in the stock market. Today's topic is the top 5 stocks to buy now, and we have carefully selected companies that are poised for growth in the current economic climate. Investing in the stock market can be a daunting task, especially for beginners. With so many options out there, it can be overwhelming to determine which stocks are worth investing in. That's where we come in. We've done the research and analysis for you, and we're here to present our top 5 picks. Before we dive into the stocks, it's important to note that investing in the stock market always involves some level of risk. It's important to do your own research and understand the risks and potential rewards associated with each stock. With that being said, let's get started with our top 5 stocks to buy now. Number 5, Adobe Inc. A leading provider of creative software, Adobe is well positioned to benefit from the ongoing shift to digital content creation and distribution. With a strong product portfolio and a proven track record of growth, ADBE is a good choice for investors looking for exposure to the technology sector. Adobe was founded in 1982 and has since become one of the largest software companies in the world. The company's product portfolio includes a range of creative software, such as Photoshop, Illustrator, and InDesign, that are used by professionals in various industries. What sets Adobe apart from its competitors is its focus on innovation and its ability to stay ahead of the curve. The company is constantly releasing updates and new products that cater to the needs of its users. In terms of financial performance, Adobe has been consistently growing and profitable. The company reported a revenue of $17.61 billion in 2022, which was an increase of 15% compared to the previous year. Adobe's net income was $4.75 billion in 2022, which was an increase of 17% compared to the previous year. The company's balance sheet is healthy, with a debt-to-equity ratio of just 0.32 and a current ratio of 2.3, which means it has enough current assets to cover its liabilities. Adobe's success can be attributed to its strong product portfolio, focus on innovation, and its ability to capitalize on the ongoing shift to digital content creation and distribution. The company has been expanding its offerings beyond just creative software, with its Adobe Experience Cloud, which offers digital marketing solutions. This diversification has allowed the company to reach a wider customer base and has helped drive its growth. In conclusion, Adobe Inc. is a leading provider of creative software that is well positioned to benefit from the ongoing shift to digital content creation and distribution. Its strong product portfolio, focus on innovation, and proven track record of growth make it a good choice for investors looking for exposure to the technology sector. With the increasing demand for digital content, Adobe's future looks promising. Number 4, Jacobs Engineering Group, J. Current price $121.89. Research firm CFRA rates J as a strong buy and recently raised its target price for the shares to $176. With a global focus on green infrastructure initiatives, J is poised to benefit from the growing demand for sustainable infrastructure projects. In this segment, we will be discussing a company that is rated as a strong buy by research firm CFRA, with a target price of $176. J is a company that focuses on green infrastructure initiatives, which makes it a good choice for investors looking for exposure to the growing demand for sustainable infrastructure projects. Background: Jacobs Engineering Group is an American multinational engineering company that provides professional, technical, and construction services to a variety of industries. With a market cap of around $16 billion, J has a global presence in a wide range of sectors, including aerospace, defense, transportation, and water. One of the reasons why J is a good stock to consider is its focus on green infrastructure initiatives. With the increasing demand for sustainable infrastructure projects around the world, J is well positioned to benefit from this trend. The company has expertise in areas such as renewable energy, clean water, and sustainable transportation, which makes it a good choice for investors looking for exposure to this growing market. In addition, J has a strong track record of profitability and growth. The company has a history of delivering solid financial results, with a compound annual growth rate of over 10% in revenue and earnings over the past 5 years. This is reflected in CFRA's target price for J, which is significantly higher than the current market price. Jacobs Engineering Group is a good stock to consider for investors looking for exposure to the growing demand for sustainable infrastructure projects. With its expertise in green infrastructure initiatives and a strong track record of growth and profitability, J is well positioned to deliver value to investors in the long term. Number 3, Union Pacific Corp. UNP. With a dominant position in the western United States, UNP is a good choice for investors interested in the railroad industry. Railroads are an attractive industry due to the high barriers to entry and the relatively stable demand for transportation services. In this segment, we will be discussing a company that has a dominant position in the western United States and is a good choice for investors interested in the railroad industry. Railroads are an attractive industry due to the high barriers to entry and the relatively stable demand for transportation services. Background: Union Pacific Corp. is an American transportation company that operates one of the largest rail networks in the United States. With a market cap of around $154 billion, UNP has a dominant position in the western United States and serves a wide range of industries, including agriculture, automotive, and chemicals. One of the reasons why UNP is a good stock to consider is its position in the railroad industry. Railroads are an attractive industry for investors due to the high barriers to entry, which means that there is limited competition in the market. Additionally, the demand for transportation services is relatively stable, which can provide a reliable source of revenue for the company. UNP has a strong track record of profitability and growth, with a compound annual growth rate of over 5% in revenue and earnings over the past 5 years. The company has also consistently paid dividends to its shareholders, which provides a steady stream of income to investors. Number 2, Stryker Corp. SYK. A medical technology company that specializes in orthopedics, Stryker is poised to benefit from the aging population and the growing demand for joint replacements. With a solid track record of growth and profitability, SYK is a good choice for long-term investors. Stryker was founded in 1941 and has since become one of the largest medical technology companies in the world. The company's focus on orthopedics sets it apart from its competitors and has allowed it to carve out a niche in the industry. Stryker's products include implants, surgical equipment, and instruments used in joint replacement surgeries. The company has a reputation for quality and innovation, which has helped it maintain a strong market position. In terms of financial performance, Stryker has consistently delivered solid results. The company has seen steady revenue growth over the past few years, with a revenue $18.4 billion United States dollars, up 7.8% from FY 2021. Stryker has also been profitable, with a net income $2.36 billion United States dollars, up 18% from FY 2021. The company's balance sheet is healthy, with a debt-to-equity ratio of just 0.47 and a current ratio of 2.5, which means it has enough current assets to cover its liabilities. Stryker's success can be attributed to its focus on innovation and its ability to adapt to changing market conditions. The company invests heavily in research and development to create new products and improve existing ones. Stryker also has a strong distribution network, which helps it reach customers in different regions of the world. Furthermore, Stryker has a history of strategic acquisitions, which has allowed it to expand its product offerings and diversify its revenue streams. In conclusion, Stryker Corp. is a medical technology company with a strong track record of growth and profitability. Its focus on orthopedics, reputation for quality and innovation, and ability to adapt to changing market conditions make it a solid choice for long-term investors. With the growing demand for joint replacements and an aging population, Stryker is well positioned to continue delivering strong financial performance in the years to come. Number 1, Exxon Mobil, XOM. In this segment, we will be discussing one of the biggest players in the oil and gas industry, with a market cap of $357 billion. Exxon Mobil is a company that has been around for a long time, and it is worth considering as a hedge against inflation. As gas prices tend to rise with inflation, owning XOM could be a good way to combat rising prices. Background: Exxon Mobil is an American multinational corporation that is headquartered in Texas. It is involved in every aspect of the oil and gas industry, from exploration and production to transportation and marketing. The company operates in over 200 countries around the world, making it one of the largest integrated oil companies in the world. One of the reasons why Exxon Mobil is a good stock to consider as a hedge against inflation is because gas prices tend to rise with inflation. As the cost of goods and services increases, so does the price of gasoline. This means that owning shares of Exxon Mobil could help offset the rising cost of gas and other goods. It's also worth noting that Exxon Mobil has a strong balance sheet and a solid dividend history. The company has a dividend yield of around 4%, which is higher than the average dividend yield for the S&P 500. This means that investors who buy and hold XOM shares can earn a steady stream of income from their investment. However, it's important to note that investing in Exxon Mobil comes with risks. The price of oil and gas can be volatile, and this can affect the company's profits and stock price. Additionally, the company's long-term growth prospects may be affected by the global shift towards renewable energy sources. Exxon Mobil is a good stock to consider as a hedge against inflation, thanks to its strong position in the oil and gas industry. However, investors should keep in mind the risks associated with investing in this sector and should always do their own research before making any investment decisions. Thanks for watching.